Hi, everyone. Thank you so much for coming out to the last day of Startup Boston Week. My name is Ashley Johnson, and I'm one of the organizers for this event. So currently, you are logged into Craze, deciding among angel investors, VC, and private equity. While we wait for people to kind of navigate around, just as a reminder, we absolutely love questions. So please use the Q&A tab on the far right of your screen to submit the questions that you have during the session. And we also have an awesome social media competition floating around. You'll want to pay attention to what our speakers are saying today, then post an awesome quote on social media from them using the hashtag SBW2021. You'll then be entered to win one of 5 $100 gift cards to a Black-owned Boston business. So we're going to get started, and I will kick it over to Allison.
All right, awesome. Hello, everybody. Thanks for joining our session. We're gonna start out with some introductions, and then we're gonna go right into a poll. And I apologize if my camera is going in and out. I don't know what's happening, but I hope you can all hear me. So I'm Allison Byers. I'm the founder and CEO of Scroobius, which is a startup focused on increasing diversity in the startup ecosystem by providing the tools and education and community that founders need to create investor-ready pitch material. And we're building a platform to help early-stage investors discover those founders. Prior to Scroobius, I co-ran a startup medical device company for about 5 years that was spun out of MIT and the Leahy Hospital System here in Boston, where I was one primarily responsible for fundraising. And we did raise almost 10 million, going from friends and family through a Series A prime with grants and bridges and all that fun stuff in the middle. So that was my experience there. And I'm going to let our lovely panel of other women, which I am so freaking excited about, that we're an all-women panel at a not all-women event, introduce each of themselves. So based on where you guys are on my screen, I'm going to start with Pauline. You want to give us a quick intro?
Yeah, absolutely. Thanks, Allison. It's great to be here. I'm Pauline. I'm the co-founder and CEO at Pasito. At Pasito, we're on a mission to make the life of parents and caregivers better. And our products reduce the burden of caregiving and also deliver tax benefits for employers who are our clients. I'm an engineer by background, but I'm a little bit of a finance nerd by trade. I spent the past 8 years at BlackRock, which is a really big asset management company. And the last 4 years there, I was a private equity investor. I invested in large growth companies, but I also fundraised for the different funds at BlackRock. So I have a pretty good sense for how general partners think, and really excited to share that experience here today.
Awesome. All right, Zoe, you're up next on my screen.
Perfect. Thanks so much, Allison. Hey, everyone. My name is Zoe Berry. I am a serial entrepreneur and angel investor. I'm based out of Boston. I grew up in New York City. My first company I founded when I was 26. It was a digital healthcare play, best described as the Amazon Prime for $100,000 life-saving medications. I raised $42 million for that company as a woman sole founder. So pretty exciting, metrics there. Shows that it's possible for everyone else who's, hustling at the early days of fundraising and figuring out their founding teams. That company was acquired after 8 years by Allscripts, which is a large publicly traded company. I founded a new startup in the fintech space. We were just coming out of stealth mode. We actually launched and went live on the App Store yesterday, a bit of a soft launch. I raised $8.5 million for that company over about 18 months. So happy to talk about the fundraising process. I'm also an angel investor, as I mentioned, and I mentor with Techstars. And so I really see sort of what the different metrics and milestones are across each fundraising stage. And I try to help bring clarity and distill this sort of mystery of fundraising for many entrepreneurs.
Awesome. And Sarah, let's hear about you.
Hey, everybody. It's great to be here. This is only my second video call this week, so I feel like something's going really right. I've got all my video energy today. I'm a partner at Pillar. We're an early stage venture firm based in Boston, co-founded by 22 CEOs from leading companies here like TripAdvisor and Ginkgo Bioworks and Wayfair and DraftKings. We make pre-seed and seed stage investments in founders, primarily Boston-based founders, and about 50% of the companies we back are university spinouts. So we love working with people who are just starting with research or an idea or are very early on. And prior to joining Pillar, I spent most of my career on the operating side, helping to build enterprise SaaS and consumer companies. Most recently, I was on the management team of a company called Pluralsight, which is the world's largest provider of IT, dev, and creative training. And I'm excited to be here.
Thank you, everyone. We have an amazing panel, so I'm excited. And we also have, it looks like almost 120 people watching live right now. So we're gonna drop some great insights. So let's start with a poll to get a sense for where all of you in the audience are in your fundraising journey. So I'm gonna open this up. If you could all go to poll over on the right-hand side of your screen, and just let us know, what stage you're at, so we can all get a sense for that. We'll give just a little bit of time. All right, answers are coming in. Looks like we've got most of the audience is somewhere between wanting to learn but not quite ready to fundraise yet, or just kind of planning their raise. We've got some folks who are actively raising. So we're really focused on early stage. So we'll try and address a lot of that when we're chatting, kind of that pre-seed or figuring out what we want to do there. Okay, so I'm going to leave the poll open, and if something drastically changes, I'll pipe in. So I guess to start out, I think it makes sense to talk about the different types of fundraising rounds, because there's a lot of confusion among founders. And I think a lot of rounds today really bleed into each other. And it's hard to know, am I going after a seed raise, or is it really a pre-seed? Or how do you define friends and family versus a pre-seed? How do those things play into each other? And today it's not always the amount of money that you're raising that defines the stage that you're at. So I'm going to start here with Zoe, because I know she is an expert in this area, teaches about it, has been through it all. So help us kind of define and frame, how do you think about that progression of stages and knowing where you are?
Yeah, great question. I think I mentioned this when we were backstage, but my favorite round is the seed round, because everyone's raising it and almost no one is actually in the seed round. So working with Techstars, I actually built this entire seminar called What Stage Am I Anyway? And it goes and answers exactly this question. So I encourage everyone to start with a friends and family round. Usually it's the first round of financing that's done. You get some early angels in. You're really learning the mechanics of how to close. You're learning the buying signals, and you set the valuation. I typically recommend that you do it on a safe note. And usually there's some sort of cap. And for first-time founders, it's usually in the $2 to $4 million range. This is the stage where no one's taking a salary. You're trying to get some early proof of concept done. You're just trying to get the founding team together and really get a pitch deck together and understand sort of the metrics of your industry. What problem are you solving? How much money can you make if you solve this problem? What's the willingness to pay for customers? The pre-seed round is once you have a little bit more proof of concepts and metrics under your belt, and you're going to go out there and try to raise additional capital, somewhere probably around $500K, to try to start hiring some people. So you might get the team up to about 6 people. They're going to be taking early salaries somewhere in the like $60K-ish range, and you'll be giving out a couple points of equity for those people. Often a prototype is built around this stage. You are, again, drilling down in what the business model is. Is it a SaaS business model? Is it a services business? Is it, fee per click or engagement, and some of those metrics, right? So you have an early idea of how you're going to get your customers and how much they're going to pay, but they might not be paying yet. Once you get to the seed round, my favorite, and this is the one so many people puff up their feathers and say they're in the seed round and they've missed those first 2 rounds of financing. And this is if you're not getting finance and people are saying you're too early, it's because you missed these 2 stages. You really have to be doing about $10,000 a month in revenue for your seed round. That's usually like the sort of understanding of, yeah, okay, if this company is doing that much, we'll trigger a seed round. And the really important part is you're now sort of understanding how customers are paying and how you're getting them, what features you might need to build in order to get customers to pay more or to get more customers. By the end of the seed round, you're going to be doing about $100,000 a month in revenue, and that's what's going to trigger your Series A. So if you're thinking that you're raising a seed round and you're not turning on revenues, you're probably not at a seed round. You probably should be at a pre-seed round. And so those are some of the metrics that I think about when I, coach entrepreneurs and try to understand the fundraising process. And if you're not getting traction, it's probably because you missed on what stage you are.
That was an awesome overview. Thank you. Very comprehensive. I want to let Sarah, do you have anything to add or things that you want to talk about from a VC's perspective when people come to you for different stages?
Yeah, I love Zoe's clarity. I think like what I'm seeing lately is there is no clarity. It's really hard to tell what stage you're at. And there's a lot of capital in the market right now, which means that for certain spaces and certain founders, money is free flowing. It means you could raise potentially sooner or earlier than you would expect to, have less proof points in place. That could be a good thing or a bad thing based on where you are. We are typically, for the companies we invest in, we're the first capital in. So sometimes there might be some angel money or friends and family in the business, but oftentimes we as an institutional investor are coming in as that first money. And so you might meet institutional investors who are happy to make that big bet earlier on and write you a seed check or a pre-seed check without those proof points when you really are just in that research or idea phase. And so much of that is about like the personal relationship, the personal connection with that investor. Is it a space they're interested in and knowledgeable about? Do they believe in you as the founder? Because so much of it is a people connection in those early days with an investor. So I think it's really hard to tell, which can be pretty confusing for founders. I do think, if you're in a moment where you are still trying to feel things out, where you have an idea and you need to better understand your customer, it's great to raise a smaller amount of money to give yourself the room to do that before you go harder and raise that bigger round when you have more clarity. But it really depends. You might be a hardware company that needs more money to get started. You might be a founder that doesn't have access to a lot of friends and family capital, and you need to earn a salary in order to be able to pursue this business. You have a family at home and you need to earn a salary to pursue this business. So you might need to raise that money earlier on. And it's all about understanding if there is an investor with an appetite to invest in you and invest in your space right now. But in terms of, round sizes, we're seeing everything these days. When I got into this business 5 years ago, I think the average seed round was somewhere around kind of $2-3 million, maybe up to $4 million. And now we're sometimes seeing seed rounds that are $8 or $10 million on pre-money valuations of $20 or $30 million, depending on the space. So it's sort of Wild West right now. And I think the most important thing to do is figure out where are you at? How much capital do you really need to prove out this stage of your business, and who's the right partner for you?
And I would say for the different founders out on the call that are thinking about raising their whatever you call it, as Zoe mentioned, right? Your friends and family, your pre-seed, your seed. There are certain things you can do to maximize your ability to actually get the money you need in order to get to the next round or to the next phase of growth of your company. And I think Sarah said it very well. It's about the relationships that you've been building with angels or with institutions that believe in you as a person. But you also need to prove that the market is big enough. And I think that's one thing that is sometimes doesn't come across when entrepreneurs are pitching. That's a really important one. I think you also need to have clarity on the business model. And obviously, if you have some proof points on revenue or users, that's even better. But I would say those two are really, really important, and they can really carry a lot of weight in conversations, even if you are really early stage.
So it sounds like, Pauline, kind of going off of that last point, maybe talking about, other than just cash flow management, and Zoe, you've hit on this a little bit too. Well, I mean, you all have, but how do you know when it's the right time for you to do what stage of your raise, right? So Pauline, you were talking more about being prepared and knowing certain things about your market, or having done maybe some research or some early testing? How do you think about just strategically the point where your company is, the milestones you've hit, or the comfort level you have in communicating different points about when to know I'm ready to go raise funds, I'm ready to go approach people?
I think the first thing to say there is that you never have 100% of the answers. So if you wait to have 100% of the answers, you probably will never get to the raise, and you will never, your company will not succeed if it needs money. So that's the first thing you really need to internalize, and you need to be uncomfortable with. You need to be comfortable being uncomfortable in some conversations with investors that you'll have. You need to have the confidence in yourself and your team that you will figure it out. So that's the first thing. The second one is you need to raise money when you don't need money. That's really important because it changes the power dynamics in the conversations you're having with investors, right? If you wait until you have 1 to 2 months of run rate left, and you are desperate to bring in capital into your company to pay payroll, that's going to be a really different discussion. A lot of investors are also not going to want to take that risk on you. So just get out there earlier than you think you can, even if you don't have all the answers, and label yourself correctly, label your round correctly, as Zoe was saying, so that you can target the right people who have an interest at the stage that you're in. But ultimately, it's about getting out there and having those conversations as early as you can. I don't know what the other panelists think.
I run a pretty tight process when I fundraise. So one thing I recommend is, if you're going through all those stages, friends and family, pre-seed, seed, post-seed, it's my new favorite one, Series A, you're asking for how much money am I raising and what's the use of funds? And the use of funds ties into the milestones. So if I'm going to hire 3 engineers, I'm going to build a prototype. If I'm hiring 2 salespeople, I'm going to get this many customers. I think, if I'm going to put this much in marketing, this is what the CAC is going to look like. And then through those milestones, what are the triggers that would enable you to get to the next round? It's a hard exercise when you're doing it for the first time, but this is where, if you build an advisory board, you can get serial entrepreneurs to really help you understand, what do you think, the comps are. You're looking at the competitor landscape. How much did they raise? What milestones had they hit, right? And you can start to crystallize this process. Once I have that sketched out, and I try to hit achievable milestones across each round of financing, I give myself, 6 to 9 months to get a financing done. So I rank investors A, B, C, D. It's a really thoughtful exercise. I start with the D tier investors. These can be premier VC funds, but there's a lot that goes into what makes a fund a D tier investor. Did they close a fund recently, or are they at the tail end of their fund? Are you talking to a partner? Or are you talking to a venture partner, right? Who's going to sit on your board? Is it going to be an associate or someone who founded the firm and has carry in the fund, right? These are all sort of the metrics that go into it. And I like to get the prevention questions out first. And those are the objections to the business and things I don't know. So if I start with the D tier 9 months out, I can reduce the friction and bump up. And I usually have a sense for who is my A tier investor, who is my dream fund, who is my dream partner at that dream fund. And I pitch them basically last, so that I've built momentum, I've gotten the objections out, and I have 9 months. I have time to fix those problems. Sarah mentioned the relationship component. I also highly recommend getting advice from these funds. It's not just about money. If you ask for money, you get advice. If you ask for advice, you get money. So in that process, you're often building a rapport with investors and testing, are they really value add? Is it just the brand name Sequoia, or are they actually going to have a partner that really is a fit for me and is an expert and can help me de-risk and grow this business? So yeah, thoughtful process. I don't just go out and randomly raise money. So I encourage people not to do that.
I'll add one more thing there. We typically advise our companies, like both Zoe and Pauline mentioned, to head out to raise with plenty of runway. So typically we've advised people to head out 6 months prior to cash out. Things are moving very fast these days. So part of the reason we told people that historically was it can take a while for a raise to get done. Now it might happen in 3 days to a week, which I think is really unfortunate because it doesn't give you much time to get to know each other. And it's a pretty long-term relationship. But I think and things are moving fast these days. And so I completely agree with Zoe. Run a tight process, be super thoughtful about who you're targeting at the top of the funnel so that you don't waste an ounce of your time targeting the wrong people. But the other thing we're seeing a lot in our portfolio now is raises coming together opportunistically, where founders weren't necessarily intending to raise, but they have built those strong relationships with investors who've been following their progress all along. And investors are coming in to do preemptive rounds or kind of initiate the round. And what you want to make sure of in that scenario is that there are a few other horses in the race. So you might have an investor who you've built a great relationship with, who gives you a term sheet or approaches you about doing a preemptive round. And you want to be able to calibrate on the market and also have other investors to choose from in that situation. So if there's a reason to do that, you shouldn't just raise capital just because the capital is in front of you. But if there's a compelling reason to do that, like it gives you the opportunity to get out in front of your competition and hit the gas if you have some good proof points going, great. Just make sure that you still run a process even in that scenario and you're choosing the right investor for you and not just the money that's in front of you at that moment in time.
I totally agree with that, Sarah. And I just wanted to add a couple things for the entrepreneurs listening. So on Zoe's point of running a really tight process and having that list of investors and ranking them based on the value they can add to your business, you can try to figure that out on your own, but it's also really valuable to use your network. So share that list. Don't be shy about it. Share it and get input from advisors and people who've been following you and supporters. You never know who knows who, and a warm introduction is always better than a cold outreach, and speaks to kind of the relationship element that we've been talking about. The second thing is, maybe you don't come from the world of VC, and that's totally fine, right? You can cultivate relationships over time. Investor newsletters I've found are really, really powerful to grow that network and allow people to follow you and get to know you, even if you're not dedicating them 30 minutes of your time every 2 weeks for a phone call. So building out your investor newsletter, being really thoughtful about what you're putting out there, how you're representing the company, being really transparent about what's going on at the company, I think really goes a long way in people getting to know who you are as an entrepreneur and the success that you can later bring them if you bring them into a future round.
Just ask investors to opt into your newsletter. That's the only build.
Yeah, that's true.
But I love getting them. Like if we've talked about like, hey, can I send you this? I love being able to follow along. But if you randomly show up in their inbox, they may not pay as much attention to you.
It's actually a great litmus test, Sarah, right? If you hit unsubscribe, then that investor is not interested in following up on your progress. And if you ask them if they want to opt in and you don't get a reply, then they're also not interested. So it's a great litmus test, even if you get tough feedback that you weren't hoping for when someone says like no thanks or no response. So I do recommend asking first.
Yeah, and there's different types of communication too, right? I think a lot of what everyone's just been talking about now is that element of a slow burn or a long game or whatever you want to call it, about cultivating relationships before you're just hitting the phone or hitting the emails asking people for money. They want to get a sense for who you are as the founder and as the steward of the capital that you're considering investing in. So there's, just general marketing newsletters that go out to everyone is different than I think what Pauline was talking about with an investor update or investor newsletter. So those are some key differences with different expected outcomes. And yeah, having a targeted investor update that goes directly to someone's inbox without them saying, yes, we would like to receive these, is perceived differently than if, they said, yeah, keep me up to date, add me to your monthly newsletter or whatever your distribution list is. Those are different points of communication.
I wasn't advocating for spam. So
Pauline just wants you to spam everybody. So that's what I'm taking away from this conversation. Let's move on a little bit. I'm keeping track of time. We're at about 11 o'clock, and we also have over 130 people watching this. So this is clearly a very important topic for a lot of folks. And for everyone in the audience, if you do have questions, put them in the Q&A. I'm trying to look there when I can, and I know Ashley will pop in if I'm missing things, but we'll definitely try and get to those. So I'm going to move on now from round type to investor types. And I think here there's also some confusion, and there's also a lot of anxiety around, again, this really early stage where it seems like most of our audience is, in terms of what What if you don't have friends and family? What if you don't have a pre-existing network? How do you create that list when it's maybe not funds, or maybe it is, or, and it's individuals, it's angel investors or angel groups? How do we think about the friends and family, the angels, the angel groups, the VCs, the PE, help us get an understanding of a typical profile of each type of investor, what the benefits are in working with those investors, and maybe some pitfalls to look out for. So I'm going to kind of go around and have each of you cover one type of investor. Pauline, I think I'm going to start all the way at the end, at the later stage, and work our way earlier. So can you give us a sense for the typical PE investor, where that plays in, and just help us understand how does PE fit into what we're talking about?
Yeah, of course. So private equity is a bit of a catch-all phrase, right? It actually encompasses a lot of different companies that may be investing in mid-cap companies. They might be doing leveraged buyouts. They might be taking companies public that were previously listed on the market. So I think the first thing to understand about private equity is that they're not all the same. And sorting through them is, I think, even worse than sorting through venture capital firms out there. So that's really important to understand. I think the other thing about PE is that for the most part, they're trying to take a majority stake in your business, and they're looking at businesses that are much, much larger and later stage. So a lot of people on this call, on this panel, are, maybe earlier in their development of their companies, right? You're not going to be thinking about private equity or going to private equity until much, much, much later, when your company is valued at 50 million plus. So maybe that's what I'll say about private equity. The metrics involved in private equity are also really different to venture capital, and when it comes to the KPIs that you want to show investors, and also the level of revenue and profitability that you need to show in order to attract private equity capital. So the great news is a lot of people here won't have to think about private equity for 4, 5, 6 years, but it's important to kind of be able to distinguish private equity to venture capital.
All right, and as such, Sarah, help us understand venture capital.
Sure. Even venture capital is a broad category, but I'll talk about seed to start. And it's all blending together. But first, I also do want to just respond to a point you made, Allison, which I thought was a great one about people not having access to VCs or folks in their network who they can fundraise from. My mom was a teacher, my dad was a principal growing up, so I knew nothing about tech or venture or anything about anything in this world. And so I definitely had to start at ground zero when I was on the tech side. And I think when I was getting started, there really was a wall between VCs and founders, and it was sort of hard to reach out to VCs. And I think a lot of VCs are becoming more proactive about trying to build their communities and be more accessible through office hours, through events, through, all sorts of things. And so I think that creates a nice entry point for people to really be able to reach out. I also think a lot of VCs are ego driven. So if you write to them and you say, I loved your newsletter, I loved this thing you posted about, and you send a really personalized note, that's another good way to get people's attention. So just a short detour on that. But in terms of VC and seed specifically, so, I mentioned before, I think many seed stage investors are investing anywhere from, no revenue, just an idea, just research, all the way to, let's say, sub $1 million. It used to be that once you were at $1 million in ARR, you were ready for your Series A. Sometimes the Series A is happening before $1 million in ARR. Sometimes it's happening after now. It's a pretty blurry line. But I think in terms of seed stage partners, there are lots of different types of firms. There are firms like ours that are focused explicitly on pre-seed and seed, and that's where they play. They like to operate at the early stages and roll up their sleeves and really get in it with founders. There are lots of multi-stage firms now, which, many of the bigger, larger firms that were used to be historically investing at the Series B or Series C are now going multi-stage and are going all the way down to the seed. I think the question for you in evaluating which is the the right path for you. Many of those firms, not that I'm biased, are investing earlier to get a toehold in those companies so that they'll be in at the later stage rounds. And they may not be willing and ready to invest as much energy into you as funds that are exclusively focused on the seed stage. It's not true across the board. There are lots of multi-stage players that really do add value and help. But I think the most important thing for you as a founder to do is spend time with the partner or the person who would be leading the investment opportunity with you. Really get to know them. Watch what they do in the process. Are they adding value for you in the process? Or are they just trying to kind of teach and boss you? Because that's what the relationship is going to look like later on too. So watch for those cues and those signals early on to see if they're creating value, and then talk to other founders who they've invested in the past and understand what their experience has been like. But I think in VC now, you want to know at what stage is the firm investing, and at each stage, what does their role look like, and how are they adding value, and what do they bring to the table?
Awesome. So if anyone's going to reach out to Sarah or Pillar, make sure you compliment them. That's a hot tip from there. All right.
I'm a hardcore introvert, and that reading anything about me in my own email will make me extremely uncomfortable.
Well, mixed message. It's a mixed message there. All right. So Zoe, we actually have a question that I want to bring up, but I'm going to wait until after Zoe gives us kind of a profile of, help us understand both angels, just individual angels, and angel groups, which, really there's a lot of angel groups popping up all over the place, and they play different roles. Help us understand that group of investors.
Sure. And Sarah, not to make you blush, but if you go into the chat section, you can see the session notes, and everyone's getting some compliments. I just discovered that. So, all right. So let's talk about the different angel types. So I can also give my personal experience, right? I didn't come from the tech world. And when I raised my first round as a first-time founder, the friends and family round, I had one family member participate, but the other people that were in that were coworkers, people who I'd worked with previously, and they just thought I was someone to bet on, somebody who had lived the pain point and the problem and was like, I need this product so badly. I desperately want to be part of the solution. And then somebody who was an expert in the industry. So my first company was a healthcare company. So it was a patient that was, struggling. And another person was a doctor who hated the process today and wanted better technology solution. So that was sort of my friends and family round. And it was a $160,000 round, and it took me 10 months to raise. So it was a long slog, right? It didn't happen overnight by any stretch of the imagination. But it wasn't traditional angels. It wasn't people who had been really big angels and were on angel list and were, part of the venture ecosystem and doing lots of deals. It was people that I had convinced to become angels. And so if you're coming outside of the startup ecosystem network, these are other ways that you can think about it. I did go to cities that had big angel networks. So the big ones are Boston, New York, and San Francisco, right? So if you're outside of those areas, you're gonna be doing much more of what I was doing, which is convincing people to become angels versus immersing yourself in angel groups. There's kind of two types of angels, even within people who write checks. An angel that writes, a smaller than $25,000 or $50,000 check. You may get a couple of those together. It could be as small as $5,000. They go into an SPV, and 5 or 10 of those make a larger check. Otherwise, there are super angels, which are ultra high net worth individuals, and they write $100,000 plus checks. I have gotten an angel check as large as $1 million. So you can definitely, in one full check. So you can definitely get angels all the way up to that level. So just understanding and profiling. And I'm not afraid to ask, what's your bite size? How much experience do you have? Right? These are all things that then help me profile this person so I can speak to them. If they're a super angel or a traditional angel that's in an angel network, you talk to them much more like you talk to a micro VC, but they want to know you, they want to know the problem. It's much more sort of friendly and intimate and relationship building. If they're not from that ecosystem, you talk to them about the problem because they've probably lived it, or you talk about yourself and they're going to bet on you. So that's how to profile. A step up from the angels are the sort of angel groups and the micro VCs. And those are much more you need the traditional pitch deck formula. You want to ask for advice. You want to show some value. All investors, regardless of all the way up to PE, they want to know that they're adding value to the business and de-risking it, right? Like they all know that they have money. So you have to make them feel good that they're doing something to help, that's uniquely helping de-risk your business. So when they say, what keeps you up at night? Like answer that question honestly. I can't find a VP of engineering. They want to know that they can help with recruiting. They want to know that they can add value uniquely to this business. And if you don't answer that question honestly, you're just not going to get financed. So they don't want to know like, oh, you're giving me money on really good terms. Like that is not the right answer. So those are just a couple of different sort of ways to profile who your investor is and understand what makes them tick and what will make them write a check. Ultimately, at the end of the day, the really only thing that gets an investor across the line is FOMO, fear of missing out. So you want to create a lot of deal heat and you want to make the sense of urgency really acute. So if you're raising $1 million round, you don't want to say, I have $100,000 closed and 900K available. That is not intriguing to anybody of any investor profile type. You want to always be raising like your last tranche, right? I know there's a lot of funds that lead. You still have to create the FOMO with them and be like, I have another person who's leading, so you're not going to be in. And those are a couple of just tips and tricks for people beyond just the initial question, which is, what is an angel?
Zoe, I love that. I completely agree with everything that you just said. One more place that you might want to fish is places where you've worked before. So the people who worked with you, they know what you do, what you're capable of. And, they may not be able to invest themselves, but they can open doors for you and they know you the best of anyone. So I highly encourage other entrepreneurs to go talk to their ex-coworkers. I think that's a really big vote of confidence.
Yeah, I think that's a great point. And I talk to founders a lot about this, particularly those who come from diverse backgrounds or identify as underrepresented and don't have a natural network here, is angel investors are just people who have enough knowledge or enough assets that they would like to invest. Or in Zoe's case, maybe they hadn't even thought about it before, but yeah, now it's really intriguing to them. You can approach, and to Pauline's point, you're people that you've worked with before who already know you. Angel investors as an investor class are really fragmented, really diverse, and they are emerging in a very big way right now. So there are over 3,000 emerging angels who will make their first investment this year. And that's very powerful. So don't immediately go to, oh, I need to raise my round. I got to contact all these VCs. I'm going to make my list. I'm going to do the FOMO thing, right? All of that has its place. But I really do want people in the audience to know that there are other ways to go about starting to capitalize your business and getting what you need at the beginning. And you heard from Zoe, even Zoe, right, started off, it was a longer, tougher slog at first. And it's okay. And that's normal. Okay, so we're going to move even now earlier. We got a great question in from Justin Whitehead that says, if you can self-fund versus raise, would you? If you can self-fund versus friends and family or a pre-seed, would you? What is the mental calculus for thinking through those trade-offs? So I think that's a really good question too.
And I'm happy to answer that because I have very different experiences being an exited founder versus a first-time founder. So unless you can write $100 million into your own startup, and that is a very small portion of your net worth, I highly recommend always raising money because you want multiple perspectives around the table. That does mean that you're going to give up a portion of the equity and share. But again, if not all money is equal shades of green, you will bring in an expert that's going to help you de-risk the business, and having a thought partner is really important. I've put $400,000 into my second startup, which is all of my own money, and I invested across various stages. And I use that to my advantage, and I use that strategically. So, I wrote a $100,000 check for that friends and family round, and I essentially was the lead opening that round, saying, I'm willing to put money in and I'm going to put it in on these terms. I think one of the mistakes I made early on, my first startup, is I probably put like $25,000 to $50,000 into it, but it was more like small dollars here or there. It wasn't a check because I didn't have that ability to do that because I was basically 26 and broke. I never got that money back. I never got it in preferred shares, right? So I think ultimately at some point I got like a bonus that covered some of the early expenses that I had incurred. But it really wasn't the same thing. If you can sit on both sides of the cap table, that is what the most sophisticated serial entrepreneurs do. And it's something no one ever told me when I was a first-time founder. And I greatly regret not knowing that information, but you should definitely be participating in your own rounds of financing if you can. The trick is to do it at normal market valuations, right? You can't do like some cuckoo, crazy out there valuation. And interestingly enough, as an investor, the lower the valuation is, the more preferred shares that you'll get for your round, right? So you're balancing your founder equity, which is common shares, versus your angel equity of your own sort of funding that is preferred shares. So you do it at market valuations, something you can say with a straight face. As Sarah mentioned, valuations are all over the place. Round sizes are all over the place these days, but there are some general sort of sniff test of things that work.
Well, I had a couple of builds. I think those are excellent points, Zoe. And I think also back up and figure out, what are you trying to do? What's your objective? Like, do you want to build a venture-backed company? And do you want to build the kind of company that's going to require you to raise a lot of capital over time? I talk to a lot of people who think they want to build venture-backed companies, but when we really get into it, they might actually be more interested in building a lifestyle company or a small business. And there's nothing wrong with that. There's a lot of kind of sexy glamour around building a venture-backed company, but actually you can build a business that makes you really fulfilled both financially and emotionally and mentally, that is not a venture-backed company. So if you can do that, and that's your objective, and do it without raising venture, that's a great path too. Then I think also, think about, does it make sense for me to invest a small amount of money at the beginning, make some progress that will significantly impact that first valuation when I go out to raise, if I'm not, raising on a safe note or otherwise. It might make sense for you to put some of your own capital into the business to get it to a point where it becomes more attractive to the kinds of investors that you want to work with. That's a personal decision around whether that's the right move for you and whether that makes sense. And I think Zoe's point is a great one. If actually by taking on outside capital, you can accelerate your path to growth because you're bringing in expertise or a network or customer introductions that you wouldn't have otherwise had access to, you got to factor that into the decision as well.
So this relates to what you were just talking about, Sarah, one of the questions that came in, and then we're going to move on and talk about working with investors versus investor types. But Diva had a question for pre-seed startups where you have a small traction build, so like early 10 to 15 users and around 50 early signups in her case. Is it advisable to go raise, or would that be considered a signal of enough traction that you should be talking to people at that stage?
I think it's really hard to say. I don't know what the business is. I don't know what 10 to 15 users, like, is it a consumer business? Is it enterprise? I think like there are a number of factors. Like, is this a hot space where investors would be interested in putting capital into this business? Do you have like real strong positive signals that those customers are indicative of other future customers to come, or like a winning go-to-market strategy? I think like if it's 10 to 15 users you have, and it's a consumer company, for example, you're probably in the angel territory of finding somebody who's passionate about what you're building, the space you're building, and you as a founder. And if it helps you to raise a little bit of capital to be able to make future progress there, then yes, why not? But if you think you can continue to make progress without raising, don't feel forced or pressured to go raise that capital. But I think a really important thing to remember is, and it is a terrible thing for you as a founder to hear because it provides you with absolutely no guidance at all, is there is no formula. There are sometimes investors who are willing to write you a $2 million check when you've made no progress at all, but they really like you and they really like your idea and they think it's a really interesting market. And then there are businesses that are like really attractive businesses that seem to have strong traction with users where investors want to see more because they're not convinced that that's going to endure over time or that you're really building a machine. And so there's not a right answer. And I think just getting out and talking to people and starting to understand different perspectives about how investors feel about the space and you, it's educational and informative. And at the very least, it helps you start to build that relationship over time so that when it is the right time, you'll have that relationship. But there's no formula.
Yeah, no, I know that was a tough one to answer, but I think it probably is top of mind for a lot of these, we're with an earlier stage crowd here of like, how much traction, or what do I need to show? What are the early signals? And to Sarah's point, it really does depend on your business, and going out and talking to people. This is what Zoe was saying before too, and Pauline. Get to know investors, ask them, ask what they think, get reactions before you go and ask them for money, and see what they say. It never hurts to ask and get that feedback, and then you're a known person. So we've got about 15 minutes left. I'm going to move on. This is kind of our last section here to talk about. I know there are a ton of questions, and I'm so sorry I'm not going to be able to get to all of them. But let's talk about working with investors. So again, kind of thinking about the different investor types, right? The angels, the angel groups, the VCs, PE, and I know there's a whole spectrum in there. But for these different stages and different types, how would you expect to work with them both in an informal capacity and a formal, right? So at what point and at what type of investor do they want a board seat? When do you need to make your board, right? I think those are probably some top of mind questions. So maybe let's start. Last time we started kind of at the end at more growth stage. Let's start at the early stage, because I think that's where a lot of people here are. So say you get your friends and family, you get your first checks in. How do those people want to interact with your management of your company?
Sarah, you and I probably have different views of this. We've been very aligned probably up until this point. Do you want to go first, or do you want me to go first? All right. I am of the very strong opinion that no one gets a board seat unless they're writing a $5 million check if they're an investor. So if you're writing a smaller check than that, you do not have the right to fire me. And say anything you want about what a board's job is. Their job is to make sure the CEO is the right person to be leading the business. And the CEO has really three main jobs. The CEO's job is to bring the vision, set the vision, say what the company's doing, chart out that path and why. They have to bring the team to execute the vision. They have to bring the money to pay the team to execute the vision. So three things that the CEO does. Bring the money can either be partnerships or investors. And then the team has to execute. So the questions get into the CEO can fire anybody in the company if they're underperforming, but only the board can fire, a majority of the board can fire the CEO. So when you're thinking about bringing on an investor, if you don't have the vision and it's not 100% baked, which is usually takes until the Series A to really have all your metrics hardened, and then you can be in a place where you can be judged, that's where you should bring on an investor. They should be writing a, pardon my language, big fucking check. And that's when they get the right to fire you.
Zoe, this is a children's show, so.
I'll tone it back down to Sesame Street. I'll be Zoe from Sesame Street. Just kidding. That's not in my wheelhouse. Conversely, there's a lot of VCs that feel as though they're taking on a lot of risk. And so they want that control early. Those are those hands-on where we're going to help you, we're going to operate with you. And it just depends what stage you are in your own founder CEO journey. Like, do you really need that support, or do you need a little bit more freedom to operate early on? The different rounds that you do also trigger those questions earlier. If you do a priced seed round, the topic of a board is going to come up immediately, because generally investors hear priced round and they know that's their opportunity to get a board seat. So I'll stop there. And Sarah, I'm sure this is exactly where we begin to diverge. And go for it. Go get everyone should hear your perspective too.
Maybe not in the way you think, but this is so, like, I obviously have said many times, we'll get involved early on. We don't always demand a board seat. And in fact, sometimes we think it's better for founders if we don't have a board seat. I think it can be good kind of practice for founders from a governance standpoint as they approach a Series A to just kind of get in the habit of convening with a board and kind of, I actually think it's a great process of self-reflection to hold board meetings and prepare for board meetings as a founder at the earliest stages. But I actually think more and more institutional investors don't want board seats at the seed stage. And in part, that's because a lot of the larger firms that are getting into seeds can't possibly sustain all the boards that they would have to sit on that match with the seed checks that they're writing. And so they want to hold off on actually like getting involved in companies at that level until later on when they're, did you have a comment, Zoe? Did you want to jump?
No, I had a question. I was like, I don't want to interrupt if I drop in the chat, but I have a question. Like, I've seen, just I've seen through all the angel investing and Techstars mentoring and whatnot that I do, that some of these bigger firms are using if they do a seed deal, they're going to try to put someone essentially training wheels, like a principal or an associate on, because you're right. The big founders of a big firm don't have the bandwidth. They're already on 8 to 10 boards. And that's like when people start to cap out, but they're using that, like, I'm going to be on the seed in a seed deal and we'll get a board seat. And this will be great training wheels for an associate or a principal.
I think it just depends on the firm. Like a lot of firms I know, a lot of partners I know at firms, they just don't take board seats. And sometimes they don't even put boards in place when they do those rounds early on. Some firms certainly will put a principal in. Some firms will put like an outside partner who's a friend of a firm in. But I don't think it's uniform across the board. And I think so much of this is about you as a founder having the conversation with the VC on the front end about, how do you work? How are we going to work together? What does that look like? I've seen angels that demand more information than institutional investors, and you better figure that out before you do that, because that's going to be a real thorn in your side. So like, I think the most important thing is talk to each other about what does that collaboration look like? Are you going to want a board seat? What's it going to look like when we work together on an ongoing basis? Like I have founders who I have weekly calls with because they want to have a weekly call. And I have founders I talk to once a month. And I have companies that I'm on the board of and companies that I'm not on the board of where I've written checks that are exactly the same size. So I really do think it's about finding a partner who wants to have that conversation with you about what's it going to be like for us to work together. And I just think like, there is no uniform formula across firms these days, and it's changing and it's fluid and it's dynamic. And so you had mentioned a point, Zoe, earlier about like answering questions authentically. If you don't start from a position of trust with an investor where you have that relationship and you talk about those things, you're going to be screwed down the line, whether they're on your board or not. Like you're going to have a problem.
So true. So true. And I actually just wanted to take the opportunity because this is such a red flag. And I view this myself as an angel investor. And Sarah, I'd love to get your opinion on it. But anytime there are those angels that have written a small check and demand a board seat, you are so set up for failure, in my opinion, right? Like these are people who wrote really small checks that want a lot of control, because a board seat is control, no matter how you want to think about it. Like that, it is a control mechanism. It's an I want information mechanism. And it's really hard to get people off of a board. I did not do it at my first company, but, heavily thinking about it now, it's just to create, either 1 or 2 year terms for independence, because even as you grow, someone could be a really great resource for you at Series A, but they're not as a board member scaling through a Series C. And like, how do you get someone off a board? There's also investors that have to roll off the board and make room for another one. Like my first startup ballooned to 9 board members before a Series C, which was nightmare fuel. I so do not recommend that, right? Like keep it small and keep it with people who are actually adding value. And that is a good conversation for early angels that are trying to finagle their way onto a board. And Sarah, I don't know if you see that and if you help clean that up at all, but that is such a dangerous point, more dangerous in my opinion than VCs or these like awful angels that want board seats.
So Zoe, I would say that asking for the board seat is not the only kind of red flag sometimes that comes from angels. Also, asking for pro rata rights, information rights. There's like a lot of things that maybe should be held for a later round that you're getting asked for a really small check that don't make a lot of sense. And you really need to think through those terms, even if it's not a board seat that you're getting asked for. But what I was going to say is boards are not the only ways that you interact with investors. And that's really important, especially if you're in the earlier stage. I think you want to be looking for people to join your cap table who are going to be helpful, right? And at an early stage, that's really 3 things. 1, introductions to potential customers. That's really, really important. Like, what does their network look like in your industry? And, can someone make an introduction that's going to convert into a paying customer? The second one is hiring. Hiring and bringing on the best people ever is going to help you build the best company you can and ultimately get you to that next round. Do they have a network to hire? Do they know the right profiles of people that you need on your company? If that's engineering, are you bringing in, CTOs to be angels for your company? That's kind of the type of people you want to look for your round. And the last thing is, can they make introductions to larger pools of capital in the future, right? Maybe you're in your pre-seed stage, and you want to start developing those relationships with the firms that you want for your seed or for your Series A, can that strategic angel make introductions for you? So there are other ways and other traits of investors beyond interacting through a board, and thinking through all of that for the initial people you let into your early rounds is going to set you up for success in the future.
I love that comment, Pauline. And I think also thinking about communication as a tool in that process. Like sometimes founders I know will feel burdened by having to like slow down to communicate with an investor, but actually like you're kind of constantly raising that next round. You're constantly thinking about tapping that group for all of those introductions that you just mentioned. And the only way they can know how they can help you is if you let them know.
Yeah, no, there was so much good insight there. And you covered, like, Pauline, you covered like 2 other questions with that one comment. But I know that Ashley did pop in, which means we're nearing the end of our time. So I'm showing about 4 minutes left. One other thing I wanted to hit on is, how should you expect investors to interact with each other at different stages? Right. So if you're in your friends and family or pre-seed stage, and if it's mostly angels, you're not really into institutional funds yet. Do angels interact with each other? Should you try and have them interact with each other? The dynamic there. And then once you bring in an institution, how do they interact with other funds, and how do they interact with those angels who took the early bets on you? I'm going to let whoever wants to start.
Yeah, So I don't usually have angels interact with each other unless I'm doing a working session. And you made a point, like if you have a couple CTOs that are angels that invested, you might do like a tech or product working session and get a call and kind of create a little advisory board or sort of angel, get perspective. In general, I kind of keep most angels separate. When you're transitioning from a early round to a round where a VC is coming in, they might ask to talk to a couple angels to see sort of how things have been going. They're trying to get a sense for how well are you operating the business. Why did the angel come in? Particularly if they're a large check, they want to know who the other big players are around the table. When you do a price round and you get to board seat, sometimes it's just one investor who takes the whole round. Other times there's 2 investors that co-lead, and you might get a situation where you have 2 Series A investors that are coming in and each taking a board seat. I try to keep investors, particularly funds, separate and in their own lanes so they don't collude on price leading into a financing. But once they're both committed and they're in, and there's not going to be any sort of adjustment to price, and their docs are signed, they're on the board, then you work very closely with those 2 investors. You try not to do the thing where you play them off of each other, right? Like that becomes really tense. And then you do start to get to points where there's tension between an earlier investor, like an A investor, and a B or a C investor. And I certainly saw that play out because they have different goals at different stages of the business. So I'll just stop there because that unpacks like a whole another element of strategy in growing your business. But I think for this audience, that probably wouldn't be as useful as just like, how do you deal with 2 investors? So I don't know, Pauline or Sarah, if you want to follow on.
The only other thing on this, and it's not directly answering the question, but when you go to fundraise, don't forget that everyone talks to each other. So maybe they're not your investors yet, but they could be. And so make sure you're being really consistent with your message. There's always back channeling in the world of institutional investors. And even in the world of angels. So it's just something to keep in mind as you kind of go out into the market.
The last thing I'll add on how we work together is we're a team, and you got to put us to work as the founder. So if you're doing a financing and you have a list of target investors, or you want us to help build that list of target investors, loop everybody in and give them marching orders. Let them know what help you need from them during the process. Like, create a list of all of the investors you're looking for, and then identify among your investor group who has the strongest connection or is the strongest point of contact, or even better, has a founder in their portfolio who can introduce you to that investor. And same thing, if you're doing an executive search, we have a portfolio company right now that's looking for a VPE and a head of product. And she gave us our marching orders. Pillar's helping with the head of product search, and the other firm is helping with the VPE search. And we're going to trade notes on candidates and how we think we should calibrate for the role. But we have a mandate from the founder. This is how you can be most helpful to us. Please do this. And so I think that's another great way to think about how to get your investors working together.
Yeah, I think that's great. And I'll share, just as I know we're out of time. I'm really early stages in the company I'm doing now, and I've got investors and a board of advisors, and I have them all in one list that I email all the time. Sarah, like you said, we are a team, and I give them their orders, right? I've got color coding in there, like this is an ask for this person, and this person is doing this. And that's how you create that sense of cohesiveness, and also sets you up for really growth and obtaining that future capital, because now you've got this team that knows how you operate and knows that you want to be inclusive. So we are out of time, right? Ashley, do we need to shut it down? Okay.
Yeah.
But I hope that you all found this informative and helpful. We're still at 130 people, so we maintained attention. Thank you guys so much. You were an awesome panel. And thank you, Startup Week Boston, for putting this on. This is just such a great event. I'm so happy that I got to be part of it, and we got to be part of it together in this panel. I'll stop talking now. Ashley probably wants me to leave.
Thank you for the great session, everyone. And we have one more session coming up. So please click agenda at the top and check it out. And thank you to all of our great panelists, and everyone have a great weekend.